Hello, and good afternoon, and thank you everybody for joining us today for our practitioners panel about the role of the investment industry in the achievement of the UN Sustainable Development Goals. My name is Mirta Castrapelli, and I'm a fellow at the Columbia Center on Sustainable Investment, CCSI, and I'm also the founder of Beyond Alpha. I'll be moderating the panel today alongside my colleague, Luciana Aquino Hagerdon, Senior Fellow at CCSI. What a year 2020 has been. The COVID pandemic has touched the life of virtually every single person in the planet in one way or another. In addition to the human tragedy that this pandemic has brought to so many, it has also brought to the surface the vulnerabilities of our social, economic, and environmental systems. This crisis has created such a shift in our reality that we believe we have reached a point of no return in regards to the way we do business today. Now, what does this mean for investors? And can the UN SDG agenda help us address these system-level vulnerabilities that are now so obvious? And what's the role of institutional investors in all of this? These are some of the questions that we are answering in a new research project set for publication later this month. But for today, I'll be sharing some initial findings to help us shape our conversation. So we found that to a large extent, institutional investors are struggling in articulating the fact that economic growth and prosperity, which is the foundation of investment performance in the long term, is dependent on our shared environmental and social systems. Now, even though some investors do understand the system-level implications of their investment decisions, we're not seeing decisive actions to strengthen these systems or to at least ensure we're not harming them. We also found that all the well-intended and very positive efforts around stakeholder capitalism and the rise of sustainable investment is falling short. So why is this happening? There are several reasons for this. So we found that most investors' explicit and implicit mandates remain centered around achieving short-term market outperformance, even at the net cost to long-term human and environmental welfare. And despite the fact that most institutional investors have long-term investment time horizons. We also found evidence that there's this widespread perception that protecting our shared social and environmental systems reflected in the SDG agenda falls under the responsibility of the government and not investors. And lastly, measuring environmental and social systems is hard. And this requires a set of skills and tools that the mainstream investment community simply doesn't have. Portfolio analysts are trained to study companies' activities in relation to the financial bottom line of those companies. They're not trained to analyze how these activities are having an impact on people and planet outcomes. So what can we do about it? The first step is to recognize that all investments have an impact and that we cannot solve system-level sustainability challenges by focusing exclusively on portfolio performance. Until we understand this, we won't be able to create a truly SDG-aligned investment portfolio. Now, while ESG integration provides information on how environmental, social, and governance issues affect a portfolio, SDG alignment investing takes the other approach. Is looking at how portfolios have an impact on environmental and social issues. You can think about it as the other side of the coin of ESG integration. Now, we recognize that this journey from ESG to SDG is not going to be easy, but we believe that this change is coming and is coming fast. The problems faced by our generation, from income inequality to climate change, are too great and too consequential for investors to remain on the sidelines. It is not enough for investors to say that as long as I'm beating my benchmark, my job is done. The increasing influence of institutional investors also comes with great responsibility, and calls for accountability is only going to increase. Now, this journey will require learning new skills around measuring impact and externalities. It will require a deeper understanding of system-level issues and interconnectedness. And more importantly, it will require that the industry evolves from focuses only on portfolio performance to people and planet outcomes. If we achieve this, institutional investors will take on the much needed role that is needed to support the SDG agenda, build and protect our shared social and environmental systems, and with that, provide the opportunities for investments for our clients and beneficiaries for years to come. So with those thoughts, I'm going to move now to our panel. It is truly my honor to introduce a distinguished group of people that I have admired for many years. Scott Kalb, he's the founder and director of the Responsible Asset Allocator Initiative at New America and the director at the Sovereign Investors Institute. Scott was also the former CIO at the Korean Sovereign Wealth Fund. We also have Christopher Quales, he's product manager at ISS ESG, and he has helped develop a new suite of product offerings around SDGs for institutional investors. We also have Rick Lakai, Executive Vice President and Global Chief Investment Officer at State Street Global Advisors. And last but not least, Ellen Quigley, Advisor to the Chief Financial Officer and Research Associate at the Center for the Study of Existential Risk at the University of Cambridge. So this panel will be divided in two parts. The first part will have some prepared questions, and this will be moderated by my colleague, Luciana. And after that, we're going to have a Q&A session with your comments. So please start typing those in the chat, and I'm going to be compiling them. So with that, I'm now going to pass it along to Luciana and welcome Ellen, Rick, Scott, and Christopher.
There it is. Hello, everybody. It's great to have you all here. So I'll start with the questions. Rick, Scott, and Ellen, do you think there is a role for the investment management industry in the achievement of the SDGs in the context of sustainable investment or multi-stakeholder capitalism? Why don't you start, Rick?
I think there definitely is. I think there's certainly a kind of bottom-up element to investment management that lends itself very well to directing capital where it's needed to address these important goals. Maybe not all of them are so easily achieved with that kind of bottom-up approach. And I think certainly it's important that investors are doing so in the context of government action as well. I mean, I think working hand in hand obviously works best. Maybe some of them are rather obvious, like climate change, where you think, well, there's already action being taken place, but in a way it gets supercharged with the steering you get from government decisions on carbon taxes or other kind of nudges or more than nudges that the industry needs. I think there is an awareness, maybe I'd part company slightly with some of Mirtha's comments about short-termism. Short-termism can be a problem, but certainly when you think about most analysts, they are focused a little bit longer term than perhaps some of the kind of suggestions that are out there. And if you can deliver good long-term performance, there's a very strong tolerance for short-term underperformance amongst institutional clients or even others, and we've seen that ourselves. But I would agree that when you're looking at these systematic issues, they sometimes are very hard to see when you're looking at a single company, because the most relevant thing for that company might be its business model, the context it's operating with. It's different when you're managing index funds, where these systematic issues become much more important. and where things like engagement matter. But I'll stop there and come back to some of these points maybe later.
Thank you, Rick. Scott, what do you think from your perspective?
Thank you, Isana, and great to be with you and to be talking to everybody here on this, attending this panel. I think that if we're going to achieve these goals, I mean, let's step back for a second. The SDGs, in my opinion, are the most ambitious project in the history of humankind. If we can achieve these goals by 2030, or sometime around that, in that time frame, we'll have made tremendous progress in dealing with the world's greatest challenges. But it's an incredibly confusing mosaic. We have 17 goals and we have 169 individual targets. And so we need a proper framework to really, I think, drive progress. And frankly, if we're going to achieve these goals, we need to drive capital into these various initiatives to make progress. So, and in particular, we need to do it in the developing world, the most populous and in some cases poorest countries in the world, if we're really going to have a chance of making this work. So my theory of change is that if you want to make a difference, you go to the top of the food chain in the investment cycle, and that's the asset owners or asset allocators who sit above and control $20 to $30 trillion of capital that needs to be deployed. And if you can get them to move in this direction, even a 1% allocation of their capital is $200 to $300 billion, and that can make an enormous difference in everything from improving education to improving infrastructure or addressing healthcare needs or hunger. So let me stop there.
Thank you. So Ellen, what do you think?
Well, I have to agree with almost everything that Rick and Scott have said, so I won't go over that ground again, but just to say there are certain things that only government can do well and certain things that only the financial sector can do well. But the financial sector can actually quite explicitly put a booster pack underneath government efforts, as they did prior to the COP21 negotiations in Paris. A large group of very influential investors came together to kind of accelerate and kind of increase the ambition of that whole project. And I think that, in addition to, I'm sure, what a lot of the other things we'll discuss in this panel around asset allocation and so on and so forth, actually signaling support for governmental agreements like that can also play an enormous role in achieving the SDGs, including climate agreements.
Thank you. So Scott, I'll go back to you. Given your experience working with asset owners around the world, what are some of the most important trends in sustainable investment you are seeing? Are SDGs part of this conversation?
So I think that the SDGs, we need to make them more overt. We need better education. We need the investment industry to embrace them as they are in terms of being the SDGs. But what we are seeing is that underneath that, we're seeing real progress being made on a number of the individual targets. So what I would say is the asset owners are moving aggressively to put capital to work in SDG 4, quality education, in SDG 7, affordable and clean energy, in SDG 9, industry, innovation, infrastructure, SDG 3, good health, well-being, SDG 2, zero hunger, and even into clean water and sanitation. The areas, there are other areas that they're putting pressure on, they're forming partnerships. So they're not investing directly, but they're trying to have change. And those are things like climate action, SDG 13, or with the TCFD, or putting pressure on disclosures, for better disclosures. Gender equality, they're all signing up to a variety of initiatives for women's rights. Life on land, they're working with forest and timber. But there are a number of, as my colleagues on the panel have pointed out, and those are areas where it's difficult for the asset owners to have an impact, and they're very important. Those are things like SDG 16, peace and justice, SDG 8, decent work and economic growth, SDG 10, reduced inequalities. What we're seeing, sadly, is in these kinds of areas, we've been moving backwards in the last last year or two. And this is very distressing. So this is worrying. We need to at least try to stop any backsliding, and we need to see good-looking, forward-looking policies in these areas to help to lay the groundwork for the SDGs to move forward.
Thank you, Scott. Rick, have you seen any significant change in how clients are thinking about sustainable investment most recently? In particular, is anyone talking about systemic risks?
Absolutely, there's been an upsurge in interest in sustainable investments. I think, first and foremost around climate. It's not the only thing. And I think we always try and generalize and sort of widen out the discussion to sustainability that encompasses more things, because when I think about my history in this industry, often I've been running index funds or been in a firm that's running index funds. The things that have gone wrong have often been unsustainable business practices, and it could ultimately relate to climate or the environment, but it could be other things as well. So that's where you lose money. And I think there's an increasing recognition that prevention's better than cure. Maybe that's a sort of subliminal message from COVID-19. But I think first and foremost it's about climate. And that's been the case for a long time in Northern Europe in particular. I think there's a greater willingness to kind of expand the lens a little bit further into other systematic risks. And like I said before, it's very difficult because when you're primarily a person who's analyzing individual securities or even analyzing government bonds at a sovereign level, some of those systematic issues are not that germane for that particular job, but they become much more significant at the portfolio level. But I think they do have conflicts, and I think inequality would be a great example. Actually, we've had a lot of discussion internally about diversity more generally and how it impinges on inequality. But when you think about our mission for boards, grow earnings in the very long term, the sort of levers they pull are those that have this sort of conflicting impact on inequality. So moving, for example, the air conditioning factory from the Midwest to Mexico, that no doubt boosts incomes in Mexico and contributes to this sense that those poorer countries are actually getting wealthier, but it's also having an impact on inequality that's negative elsewhere. And I think that's an inevitable thing we need to face up to, that those conflicts that exist within the investment universe, that if you're pursuing long-term returns, there's an inevitability to some of the things that are disruptive. So I think that they're as systematic as the ones like the climate mentioned earlier.
Thank you, Rick. Christopher, ISS has some products that take into consideration the SDGs. Why did you develop them? Who is using them?
Yeah, so as ISS, we currently have 2 SDG dedicated products, the SDG Solutions Assessment, which is a product that focuses solely on impacts from products and services and how and to what extent they contribute or obstruct the achievement of the SDGs. And more recently, this May, we released a product called the SDG Impact Rating, which looks at the SDGs and a company's impacts more holistically, looking not only at products and services, but also looking at operational performance as well as controversies. And we have also recently partnered with Selective to develop 2 SDG-based indices. What we found is that shortly after the UN SDGs were adopted in 2015, very small number of investors jumped on that opportunity and also adopted the SDGs for their strategies and now they wanted to know, how can we measure impact? And they were looking for research and for products that would let them do that. And as Rick and Scott have mentioned, there's investors that want to know what do corporates do in terms of driving a specific SDG, SDG 6 or SDG 13, what happens in that space. And also conversely, which are the companies that do very poorly in regard to certain SDGs? Are there impacts from companies that hinder the achievement of, let's say, SDG 8, for example? And so seeing this development in the market, we wanted to develop products that help investors identify those companies and to have solutions available to them that would allow them to develop those strategies. And we have since continued to see growth in that. Incidentally, the UNPRI just released a report that said 4 years ago in 2016, there were only about 2% of investors that mentioned the SDGs in any way. And now there has been a tenfold increase within just 4 short years. And 20% of investors are now considering the SDGs as a viable framework to measure impact and to look at how their investment is actually contributing to the SDGs, to the achievement of the SDGs. And we want to help investors on that path. As for the question of who uses that, predominantly asset managers. About 75% of our clients are asset managers, but we also have asset owners, hedge funds, and academics, which use our research and our products to build strategies, build indices, construct indices, and do stock picking and screenings of their portfolios. So those are the main uses, and this is what we can provide to investors to help them make sense of this SDG framework and various impacts that corporates have.
Thank you, Christopher. So Helen and Scott have this question is for both of you. What is the most significant challenge to incorporate the SDGs in an asset owner investment management? I know, Scott, you talked a little bit about that before, but why don't we start with Ellen, and then Scott, you can add a little bit more to that.
Sure. I mean, not to sound too academic here, but I think the main challenge is the paradigm that we use. So we look at, say, climate risk instead of climate impact. So, ESG, and sorry to sound critical here, but you end up stock picking within public equity, within the secondary market, and maybe reducing your own exposure to high emissions products, but you're not actually changing anything in the real world. And I work from a universal ownership lens, which takes into account systemic risks. So you actually, as a universal owner, you'd want to actually reduce those systemic risks in the real world, and stock picking isn't the way to do that. And I think that that kind of paradigm shift hasn't really happened yet, and that's kind of the main barrier when you think about it. So, you take an SDG linked project like educating girls. That actually links to at least 3 SDGs: gender inequality, inequality more generally, and actually climate change. Because one of the most effective things you can do about climate is to educate girls. They're less likely to have many children if you do that. Walmart is not going to do that. They're not going to educate girls, nor is any other large corporation. But actually, large investors should want each of the companies in their portfolios to contribute to something like that, because it would benefit everyone. There would also be an additional effect, of course, which is that you would end up with half of the population being able to enter the workforce in a way that might not have been possible before. So that's just kind of one concrete example of the way in which that paradigm shift contributes to a genuine shift in what we actually need to see, as opposed to, potentially making a bit more money because you stock picked effectively.
So, Helen, I would like to ask a little bit. So, what do you think Walmart should do in that case? I
think that Walmart's incentive will be to keep paying its workers very little, and to maybe compete at the top end for its executive to be paid quite a bit. I think it's the investor's responsibility to go in and say, actually, it's bad for the macroeconomy to have a hollowed out middle class and low wages concentrated at the low end, and soaring wages at the top end. Things like that. I think the investor has to go in and intervene in terms of everything from executive pay to externalities like pollution and so on and so forth. I really think that any individual company is unlikely to take on systemic risks without the pressure from investors, which is why it's so critical, A, that we're having this conversation, but also that investors start to take a lead on universal ownership more generally.
Thank you. So Scott, what would you like to add to this?
So I would say that for challenges, for the asset owners or for the big institutional investors, one, we do need better tools so we can make the goals into investable solutions. There is a group now that's coming out with a solution. It's very interesting. It's called the SDI AOP. It's a great acronym, or the Sustainable Development Investments Asset Owners Platform. Put together a bunch of asset owners to try and come up with an investable taxonomy for funds to use. So I think that's important. We need to, I think Ellen was talking about this, but what we need to do is increase intentionality. So it's not enough for us to go back and retrofit our portfolios and say, well, let me look and see what I've done and see how that fits with the SDGs so that I can be compliant. What we want to do is drive new capital. And that means you have to have an intentional platform. And to do that, we have to convince the asset owners, the investors, that this is not simply a social good. It's also an opportunity. There's opportunities for investment. There's also opportunities to mitigate risk. So when you invest in, there are great, as I said before, the guys are very active in education. There are very good opportunities to invest in education. There's very good opportunities to invest in food. We've seen as one of the beneficial corollaries of this pandemic we've been facing is we're seeing increased investment into healthcare and to well-being. And these are being done, a perfect example is something that you can do where you can make a return. Remember, these asset owners, if they're managing people's pension funds or long-term savings, they have to get at least a market return. But there's no reason why they can't get a return and also make a contribution to broader goals of society. So we can do that. I think the other thing that we need to do is increase awareness. I know this sounds silly. For all of us, it's top of mind. But we did a survey. We checked the 80 largest asset owners in the U.S., pension funds and sovereign funds. And we found that only 3% of them even mention the term SDGs anywhere in their public documents. And in fact, even among the areas where it's greatest, like Europe, it's a total of about 54%. So underneath, we're seeing guys doing good things, but from a framework perspective, I think we still have a lot of wood to chop to really get the message across that this can be a valuable framework for people.
Thank you. Rick, what are the best strategies for an asset manager to consider system-level issues such as the SDGs in the investment process? Would that be through engagement, ESG, integration in passive or asset or active management? What about impact? Could that be an option? Or all of them, each one playing a different role? I think you are in mute, Rick.
Apologize, Dave. I knew that would happen sooner or later. So let me start with my own sort of personal experiences. Again, I mentioned earlier that we run a lot of indexing assets. We're very proud of that history. And I've done it personally for a really long time. So you see the good, the bad, and the ugly. You own everything, and you see all the things that go wrong. And as Alan pointed out, then you're also that universal owner that might have an impact on those systematic issues. And you have to choose which ones you think might have impact in the long term for the owners of the assets. After all, it's someone else's money. And the someone else is a very wide range. It could be, retail investors in Japan. It could be US pension plans. It could be a lot of different ones. So as a fiduciary, you've got to figure out what you think is going to have that long-term impact. And if you're running index funds, things like stewardship and the way that you engage with companies are particularly important. I think there's often a sense that doesn't work very well, and you need to be somehow more active. I think recent evidence on things like climate would support the idea that is beginning to work. Boards are recognizing that they can do the things that they want to do when they've got the support of shareholders who are all pushing in that direction. It's not a panacea, but I do think that's beginning to have an impact, together with other kind of, mandatory measurement systems and the growth of things like TCFD, which has normalized climate in terms of risk management. So I think engagement's very important. So in things like gender equality, for example, that's an important area for us. And we've just published a new set of guidelines on racial diversity as well, where we're asking companies to do very specific things because we own all of them. Now, at the individual company level, it may not actually make that much difference, but across all of your portfolio, it will. But that's not to dismiss ESG integration or the other things that you mentioned, because I think if you are an analyst looking at companies, you always want to have an edge. And I think our viewpoint's been that people have had a little bit of a blind spot. And again, sometimes there's a kind of political story around ESG, but we've tried to eliminate that and get people to focus on the facts from a return and risk perspective and be as open-minded as they possibly can be in encompassing those things into their portfolio. But that's again, that comes with conflicts, which one needs to think about carefully. In other words, how cheap does a bad company have to get before you say, okay, it's a bad company in some respects, it's got a bad safety record, but it's sufficiently cheap that I'm being rewarded for that. And therefore, I want to go long of that company and maybe by engagement, improve their performance. So I think as soon as you talk about ESG integration, I think you have to accept that you don't draw lines in the sand like a divestment policy. So maybe I'll finish by divestment and then we can open up for more discussion. But divestment, I respect a lot of people in expressing their values through divestment and a belief that by divesting of certain assets, they are reducing their risk. I understand and accept that argument, but I don't think it's quite as effective as people think. And the reason for that is that finance, not just because of central bank action, it's like water. Money's like water. So you might think you're going to be able to squeeze people's cost of capital so much they'll stop doing the thing you want them to stop doing. I'm very, very, very skeptical about that. That will not work. It will drive up the cost of capital a little bit, but there is plenty of capital around that is less constrained, short and long-term capital. So I think divestment, I respect people who do it. It's a risk management tool for many. But I think the things that you mentioned, including impact, are much more appropriate. And again, to Ellen's point, it's not what you stop doing, it's what you start doing that's equally important. And although you could say, well, listed companies don't do much because that's not fresh capital, the choices made by those very, very large scale enterprises about how they deploy the marginal dollar are really, really important. And that's why the signals from investors, even in the secondary market, trying to generate alpha, are actually remarkably important in directing their own investment plans.
This is very interesting. I'm looking forward to the Q&A. You all are bringing up very interesting topics. Rick, tell us a little bit about ISS methodology and how do they incorporate the do not harm approach in the SDG aligned product offerings?
I think the question is for me and not Rick, so I'll go ahead and answer that.
Sorry, Christopher.
Yeah, I found really interesting what Ellen said about negative externalities. And of course, in our research, we're looking at corporates, and I can't speak to the intentions or the incentives that investors may have in picking various stocks. But when we developed our SDG impact rating, this is this holistic product that looks at products and services as well as operations. We made a very conscious decision to focus not only at what companies do well, which I think is what everybody wants to know, but we also look at negative externalities across the entire value chain, to look at how might companies actually harm the achievement of the SDGs, and what strategies and what measures do they implement to mitigate those negative impacts, also taking into consideration controversies that they may be involved in. So one thing that was really critical in developing this operational impact assessment was to identify or to recognize that companies have different impact potentials. So not every company has the same impact potential on a given SDG. Maybe to illustrate, if we look at SDG 3, good health and well-being, and we compare a company in the pharmaceutical sector with a company in a financial sector, let's say a bank, they may have very different impacts on that SDG based on their business model and their operations. For example, if a pharmaceutical company manages its product safety measures really poorly, or does nothing in terms of accessibility and affordability of medicines, the real world impacts are much greater and much more negative than if a bank, for example, does poorly in managing their workplace safety. So in order to account for these different impact potentials, we introduced a sector impact classification that categorizes sectors in 3 tiers: high impact potential, medium and low impact potential. And what that allows us to do is to really look at how severe are those impacts if management of those externalities is poor. And in our model, the impact classification is used to score those sectors or companies on a different scale. So for example, with a high impact classification, you may be scored on a scale of -10 to +10, whereas for the bank, which is scored low, their impact might be scored from 0 to 5, 0 being neutral. It means that their negative externalities are, in real world terms, much lower, and they may not have a negative impact. And that is something that we want to provide to investors. If they look for those companies and those negative externalities, they can identify that. And we can demonstrate in a way that if a company has a high impact potential, they first need to show that they actively mitigate those negative impacts before they can actually be assessed positively. And in that way, we can compare sectors and we can make comparisons across sectors, and also show that based on the business model, what are the most material SDGs that a company can have an impact on. So yeah, this is the kind of research we provide, but then an investor needs to make their own decisions on what they want to focus on. If those real world impacts are actually important to them, or whether they want to see a return on financial investment only. But this is one way we deal with the do no harm principles and negative externalities.
Mm-hmm. Okay, well, thank you very much. This is now, Mirta, we're ready for the Q&A section. There has been a lot of very interesting issues that the panel has raised, so I'm really looking forward to see what the audience is saying.
Absolutely, thank you, and thanks again for all your comments. So we've had quite a bit of questions on the chat. The first one is around, I don't want to use the term, but it's basically around the whole thing of SDG washing potentially, right? And unfortunately, something that is hunting the investment industry with a lot of the efforts that have happened, on the sustainable investment space over the years. So the question is, how do we create more intentionality towards investing in the SDGs, as opposed to using the SDGs as a marketing tool, or something to attach, the logos to the, to the existing actions, right? So, how do we make sure that we're really authentic in regards to addressing the SDGs? So, who wants to? Yes, Ellen.
I think, from my perspective, the number one thing you'd want to do is evaluate which asset classes the product was applying the SDG lens to. So if it was just public equity, I would only be convinced by a very aggressive shareholder engagement plan that involved voting against directors and the like, which we still actually very rarely see. I'm just going to respectfully disagree with something Rick said earlier about cost of capital. I do agree that you're unlikely to see a change on the basis of stock picking within public equity. But I've actually compiled some evidence that suggests that you could affect cost of capital if you actually go where the new capital is coming from, which is on the debt side. So most of it's coming from bank lending, but a good chunk is coming from the bond market as well. So one of the key things you can do is look at the asset mix within the fund in question. If it's venture capital, I'd feel pretty good about it's not being SDG washing, providing that it's actually applicable to in a rigorous way. But if it's public equity, I'd really have to be convinced on the basis of the engagement plan.
Scott?
I would say that in addition to the comments that Alan has made, I would also suggest that you need to sort of have some good measurements so we can measure our progress and then have accountability. And that will help to, I think, to improve intentionality and to get rid of greenwashing or SDG washing, as you called it. And maybe you start with some of the areas, because there are some SDGs that we're actually on track. Overall, I think we're a third of the way through here, and we've only got 10 years left, coming close to achieving full potential on the SDGs. I'm sure you know, but there are some where we're pretty good. I think that we'll reach the goals. I think SDG 2, zero hunger, we're already, and also SDG 3, good health and well-being. So nutrition, healthcare, these are areas where certainly in the developed world, we're already there. And in the developing world, I think we have a good chance to reach the targets by 2030. But we need to be able to measure our progress effectively. There's some areas where we know what to do, like I think SDG 6, clean water and sanitation. This is a solved problem. We know what needs to be done, but we need to scale up the solution throughout the developing world. And if we do that, we can beat that one too. We're making rapid progress on renewable energy, SDG 7, climate action, SDG 13. So that's moving rapidly. But there are many other areas we're falling behind, and I really do think that a lot of them are related to quality of life, human rights, the freedom for people to live a prosperous life. These are an important part of the goals, and I think we're struggling here. SDG 1, poverty, gender equality, number 5. There's a whole range of them, including peace and justice. And I think what it means is we need government. You need 3 areas to be successful. You need a forward-thinking government with good policies. You need good regulations, and then you need strong leadership. And if you don't have it's very difficult to move forward unless you have all 3 of those, what I would say, legs under the stool, so you have a stable base to go forward.
Thank you, Scott. Anybody wants to add in regards to these questions? I do want to mention on measurements, right? So one of the things that attracted, us to the SDG as a framework, as a system level framework, is the fact that we already have the goals, we already have the targets, we already have the KPIs. So the standards are there. We just need to act on them, right? So because the standardization has been obviously one of the biggest obstacles for ESG integration to really create the type of impact that we were hoping to create. So the SDG, we have this, so we just need to again act on it. So, but just on your point of measurement, Scott, the next question is actually a good segue to your point on emerging markets and the fact that a lot of the needs for the SDGs are actually in frontier markets in developing economies. So the question is, what are your thoughts on the capacity of blended finance? And I would expand these questions to any other strategies around the impact investment space to fill this SDG financing gap. So any thoughts there? Luciana, you can also mention, because I know you have a lot of knowledge on the impact space. So any thoughts on that?
I mean, I think it goes to, in many cases, private-public partnerships. And then, I mean, blended finance often is the type of capital that may be coming from development finance institutions, foundations. So I mean, they have been doing these type of things for a long time. They are very familiar with measurements. And I think that what's going on now with sustainable investing coming more into the mainstream is that more mainstream asset managers and traditional asset owners are looking into these type of products or structures to increase the impact.
I just comment on not blended finance, but also maybe linking back to Ellen's point about the role of investors and governments. Our clients invest a lot in sovereign bonds, as well as green bonds, corporates, and everything else. And I think in the emerging markets, that's been a very strong growth area for investors as the yield curve's flat or negative in many countries. And the research that we've done, and maybe some others, does link long-run sustainability and ability and willingness to repay and stability of the currency to some, if not all, of the SDGs. I think it's an emerging area, but this whole sense that we are providing finance, we don't want to be, in a sense, dictating to governments from a conditionality perspective. I know the IMF obviously has to do that, but there is a sense that where we're investing clients' capital in emerging market debt, that we do have this kind of smart beta ESG lens through which we're looking at the risks out there. I think particularly on demographics, things like gender equality, that really stabilize long-run economic growth, as well as the obvious corruption and so on. But I think that's another, I think, pretty powerful way in which the SDGs could be pushed forward. And I do think there's more kind of client interest because they do see the kind of stability factor, particularly as you get into the high yielding parts of EM, as being a very important thing to get a handle on.
So the next question, and thank you, Rick, for that. It's for Christopher. I would ask it to Christopher, but everybody else, of course, please jump in. So it says that educating girls can affect multiple SDGs, right? And that's great. But how do you quantify, or how could you quantify an SDG impact rating for a company? Do they get credit for all of the related SDGs? Is it a weighted emphasis on related SDGs? So how are you guys thinking about that?
That's a really good question. Thank you. And it's a difficult question. So the operational side of our SDG impact rating is based on an ESG corporate rating. So we took all the individual indicators that we assess for any given company we mapped them thematically to the individual SDGs. So we looked at which of the indicators that we assess could be applied to an SDG. Now, for some indicators, that's very easy. For others, it's very difficult. And then it's also, again, more difficult to look at multidimensional impacts. In terms of SDG 4, education, and looking at education of women and girls, that is something that is not captured extremely well for a lot of corporates, probably mostly for corporates in the education sector. So for those kinds of impacts and issues, from a corporate perspective, it might be very difficult to actually quantify the impact because either the data is not there or because it's not a focus in ESG reporting. Of course, you could also look at community involvement. What do companies do in order to promote education in underserved communities and so forth? So that is something that we do look at. But on a more on a higher level, let's say SDG targets specifically, I think it's much more difficult to quantify from a corporate perspective. But it is something that we're looking at and in whichever way we can. And yeah, like I said, multidimensional impacts are definitely reflected in our model as well. But it does depend a bit on the SDG.
Yeah. Thank you. And what is important, again, something that we're using in our research is the framework that, for instance, CCSI has put forth, this 4-pillar framework to recognize that companies' activities, it has to do with products and services, but also supply chain, with activities with the government. So understanding companies' activities from that holistic standpoint, I think that's really the way to think about SDG impact. So the next question is for Ellen. They said, well, your reframing of ESG and SDG issues as systemic was helpful. Does impact investing offer better outcomes than secondary market screening? And should universal owners shift to more capital to impact?
The answer to both questions, the very short version is yes. But I think I actually want to take this opportunity to give a bit of a defense of divestment. I'm sorry, Rick, I keep contradicting you. I do agree with almost everything you've said, but just for fun. So I think we have to be careful about what we mean by divestment. So if it's merely applying a screen and not telling anyone that you've done so, I agree, pretty much zero effect. However, there is actually a social effect from major announcements and social movements. And one of the things that we should keep in mind is that we are social mammals, and social norms do affect market dynamics. So a divestment movement has the potential to actually decrease investors' view of the long-term prospects of fossil fuel companies, for example. Equally, many of the people on this panel have said that government action is critical, and it absolutely is. And social movements like divestment can do a couple of things on that front. One is to help generate public support for legislation. Divestment has really activated youth movements in a way that hasn't been possible to do in some other ways. So that can help generate public support. But it also attracts attention to the supply side of the equation. I mean, I think most of us would probably agree that you really do need to deal with demand. But actually, if you look at all of the international agreements and almost all national level legislation, it's all demand side focused. And you have to do something about the supply of fossil fuels if you don't just want to have crowding in of, the Saudi Arabia and Russian price war earlier this year, for example. You end up with really cheap fossil fuels. It makes it much harder to transition. You're building a whole lot more fossil fuel infrastructure that then can become stranded assets, and so on and so forth. So the divestment movement has really attracted attention to fossil fuels, fossil fuel supply, fossil fuel companies, and may have helped generate some shifts in social norms and public support for legislation. So I really think it matters how it's done. If you just sell all your fossil fuels, don't tell anyone. It really is a tree falling in the forest. No one will notice. But I do think we have to look at these things from a number of different perspectives. But yes, in general, I think universal owners should definitely shift more towards impact investments, as long as it's not just renaming public equity investments as impact, which is one of my pet peeves. But yeah, as long as it's actually, venture capital or private equity or debt investments, then yes, absolutely agree that impact is much better than just screening in public equity.
Scott?
Flipping off my mic, putting on my mic. I would just say on divestment, I view, first of all, I think divestment is a very important part of any overall program that you have in terms of observing, environmental, social, or governance issues. I think it plays a very important role for all the reasons that Ellen mentioned. But I do think that that it's generally it's not an economic decision. It's a decision related to ethical or moral preferences, and I think that belongs to the stakeholder, not to the asset manager. So most of the asset managers, or let's say or the institution, most of the large asset owners I know are very much in favor of divestment, but they can't make that decision. Their stakeholders have to tell them, we don't want you to invest in tobacco companies, or we want you to divest all of your holdings in coal. And they go, okay, that's great, thank you very much. And generally speaking, what they'll do is they'll take it out of the portfolio. They'll also take it out of the benchmark, because there's no sense in being measured against a benchmark performance that includes those companies if in fact it's excluded from your overall purview. So then you might get some distorted performance measures. So I think that the divestment is very important, but I think that the actual guys who are managing the capital are going to they're more likely to base their decisions, or they really need to base their decisions on specific financial or economic factors. And then risk factors. And then it makes a great deal of sense, and they are not likely to get into trouble. The other thing I would just mention is that you may not be aware of, or I'm sure some of you are aware of, the power of regulation in this area. So for example, in the US, the regulator for pension funds is the Department of Labor. And they recently recommended a rule change in the US that would basically prohibit pension funds from considering ESG factors in their investment decision-making process. I mean, that's extraordinary. So this rule was proposed, and there were a couple of thousand of comments against it that were published, but they're still ruling on this. So if you are a big institution and the regulations make it clear that you cannot consider these factors, then it doesn't matter what you want to do. You're bound by these regulations. So the regulatory environment is very important. Contrast that with a place like the UK, where the laws were changed recently, requiring institutions to state, as part of their statement of investment policy, that they must also disclose their policies on responsible investing, so that their stakeholders or their beneficiaries or savers will have an understanding of how the company is approaching how the fund is approaching these issues. So these are complex issues, but it's not simply the steward of that capital can't simply step up and say, okay, I want to divest this stuff. There needs to be a rigorous process, and you also need to have good regulation and good policy that will then support such decision making.
Yeah, just to follow on there, we just for the record, we did write to the DOL. We did a lot of research internally about exactly how we frame that response, opposing their proposal. And in fact, there's another one coming down the track on voting as well. But we do think it's appropriate that investors take the widest possible set of considerations. They refer to pecuniary factors, which is a very sort of Victorian sounding expression. Pecuniary factors could be taken into consideration, and we think they are pecuniary factors. And again, to your point, Scott, I think divestment can be a pecuniary factor in the sense that you can put together a reasonable hypothesis that says, if I divest from these businesses, I'm avoiding a risk that I'm not being rewarded for. Now, that's a kind of inefficient market argument, but I think it's perfectly respectable argument. It doesn't always have to be an ethical or value judgment. I think you could easily make that argument about a number of different subsectors where you think, is that business really going to be sustainable in the way that the market price suggests? But I do think that whether it's through the equity market or the credit market, there is enough capital floating around to keep these businesses alive. So it may not have quite the desired effect. Can I return to impact though? Because impact may be a semantic point, but impact is very often a pure play. You're investing in something, maybe it's fresh capital, and it's going to achieve something. You're going to build a solar farm in India and get them off coal, or whatever it is. Because they are sometimes quite pure play outside of infrastructure and private equity, they can be quite small in terms of the size of the business, but maybe more importantly, their capacity to do things. And I remember when we were involved in venture capital a long time ago, we invested in a business that was, the sea snakes that generated power. And it was a great business, great technology. But if you're going to scale it up and actually have the things all over the world, you need a Siemens, or you need it couldn't be that business with a, enterprise value of $5 million, $10 million. I mean, their ability to scale up and really have an impact was limited. And I think when I think about the challenges of clean water, clean energy, they are mega investment that need to be made. And I think the impact investing is a very good spark, but in the end, it's often the Siemens of this world that need to grab this somehow, make reward them for the intellectual capital, and really run with it. That's why I think the signals at the top of those organizations, I come back to engagement again, are absolutely vital and just as important as the kind of impact investing, in my view.
Yes, this is a great point, and we do talk. Obviously, impact investing is a very important tool to use to achieve the SDGs. But we agree that there's a lot of limitations on the impact space, and one of the limitations as well is that it's very focused on solutions. And as I was saying earlier in my comments, SDG alignment should include the do not harm approach, because what we need to ensure is that at least we're not harming the shared systems, the environmental and social systems, right? So let's start with do not harm as the base of mainstream investors, and then move to solutions. So given the limitations that you brought up, Scott, in regards to the rulings that are and everything that's happening with the DOL here in the US, what are our options, I guess, for, let's say, the mainstream investment community, large institutional investors, in order to really think about this do not harm approach? What can we do about it, right? And engagement obviously is critical, and very proud of the work that State Street has done, and with Fearless Girl, and now with the racial diversity statement. So what are some of the tools that we could use today with the environment that we are in to really think about the do not harm approach of investing? It's a hard one.
So I'm sorry, I'll jump in here, but please cut me off any point. I don't want to be dominating discussion here, but I think that as most of the asset owners that I know, allocators, they, if you turn it around and to put it in sort of a negative terms, most of them I know, they don't want to willingly invest in any company that's polluting the environment, that's engaging in slave labor, or that has a corrupt business practices. I think nobody really wants to do that. So I think that it's really a matter, in terms of do no harm, the first thing to do is you've got to integrate these considerations, whether it's into your risk system or into your your investment, your overall sort of investment decision-making process. You got to integrate these factors into your decisions so that they're reflected in your portfolio. And we have enough evidence. There was a very good study that was done a few years ago out of Harvard, which talked about materiality. And what they found was that companies that scored highly on material ESG factors tended to outperform by almost 300 basis points per annum. So materiality was key. So we have tools for looking into materiality. We have tools for building it in. So I think that it's possible for investors at this stage. We're already past this argument. I think that train has already left the station. Most of the guys are either already engaged in building this into their process, or they're looking very hard at it. I think that the next stage, as we talked about the impact, is, well, how do we go, first of all, do no harm, but then the next thing is, well, how do we invest in such a way that we can make a return and also have a positive impact in terms of social goals or environmental goals. And that's complex because you're really dealing with a double bottom line, as you will, or double targets. And that gets very complicated, and you have to be careful about making sure that you're following the proper rules and regulations that govern fiduciary behavior. But I think that's the next stage, and that's still that's growing rapidly, but from a low base. And I think that's where we're headed now, even as we continue to build out the do no harm part.
Yeah. Well, we're at the top of the hour. We're now 1:30. So I just want to say thank you so much to all of our panelists to really bring this, investor perspective, either from the asset owners, asset manager, data provider, and always the brilliant Ellen with all this amazing work that she's done. Just to summarize, we agreed we need better tools to make the SDGs more investable, but more importantly, to help us measure and manage externalities as kind of that first step to SDG alignment. They need to create that more awareness and recognizing that, like I said, the change is coming and it's coming fast. And there's going to be, that call for accountability, again, not only from what is, ESG doing to my portfolio, as Ellen was saying, but how is my portfolio, impacting these environmental and social systems, right? So we need to do a lot of work on measuring outcomes and incorporating those, that information into our investment decision-making process. So more to come on that. We have our paper coming up later this month. We're hoping to provide some more insights on our work and also on some of recommendations for investors. So thank you again, Rick, Scott, Ellen, Chris, and Luciana, and hope you enjoy the rest of the conference.
Thanks, everyone. Bye.
Thank you very much.
Yeah.
Bye.